Joining us from Invesco, Senior Investment Strategist, Talley Ledger is going to discuss with us this morning, Talley, the state of the reopening. I mean, how do we kind of gauge this, Talley? Where are we along this process for overall recovery? Is it first inning, second, third? Where are we?
So when it comes to markets, which of course is what we care about as investors, I still think that this run in risk assets broadly has legs, and history would suggest that it's far too soon for this quote-unquote recovery trade to end.
So when we look at this in terms of defining it, we've got an equity market that's been running long before we even had any vaccines out. This has been going since stimulus and all the other efforts to stymie the pain happened in March. So how do we separate, Talley, and how important is that to separate out what is sort of a true recovery asset, and is it stocks? Could one argue that it's not the entirety of the stock market if we've been recovering and rallying long before any kind of real reopening?
Well, that's the point, and I think it's a lesson to remember. You know, things like GDP and earnings; these are quarterly lagging indicators that aren't going to help you get ahead of things like stocks, as you mentioned. So you really have to take your cues from things like the leading economic indicators and policy, including both the monetary and fiscal response, which has both been unprecedented. And that really helped the kind of beta or pro-cyclical trade to start working early last year. So I think we're right. And if we've been doing that, I think we stay focused on that signal. Don't get distracted by the noise and stick to that kind of risk-on trade here.
So in terms of the categories within this, do we have to consider as investors what's most closely tied to recovery? I mean, is buying the overall market and buying the stock market the best way to get exposure to that, Talley? Or does one have to specifically go into areas that have been still depressed throughout this that are going to bounce? Are there enough companies and businesses that have been compressed in price, or is everything just already ran up back to highs?
No, I think that as an investor, you really have to differentiate. And this is a great question. The recovery trade manifests itself in many different ways. From an asset allocation perspective, it's favoring stocks generally over bonds, to your point. But within the stock market, it's favoring the kind of economy-sensitive cyclical sectors over their defensive counterparts. And, you know, there's a size angle to this too, coming down the size curve, staying small over the larger companies. And, you know, there's a style angle, you know, making the choice of the deeper value-oriented segments of the market over, you know, as opposed to their growthier counterparts. And finally, there's a regional concept here too, you know, looking further afield, away from our own shores, to international markets, which, as you say, have been beaten down for so long. You know, they've been outperforming fantastically over the past year, led by emerging markets in China.
Talley, looking at some of these trends that could take hold as the recovery does the same, you got a chart looking at some of these themes that we've been discussing here, this rotation within the market and what we've seen so far. What do you look at in terms of gauging this current trend versus historical? So you've labeled the darker bars here the current trend. How are you defining that? Is this like what we've seen already versus what one would expect if a real kind of post-recession recovery is taking hold?
Yeah, I mean, this is less of a forecast as much as it is looking back at these typical kind of risk-on performance patterns and juxtaposing them against recent dynamics. And things are playing out exactly as you might expect based on that historical playbook. But the true lesson here is, you know, naturally, given the high velocity rally across all of these, different risk-on categories, I think investors are naturally wondering, hey, stocks are looking overbought here tactically. Should I pull the plug on risk assets? I think the answer is no, and it's important to know your history in order to get a sense for where we are now and where we might be heading.
Interesting. So looking at this and kind of using the history as a guide, Talley, it's interesting because we just went through this very physical crisis, right? This black swan event. But within that, our market snapped back, as we've been discussing. And for many, they look at the history of markets, and generally, a lot of it, either you only really crash one of two ways, right? It's either black swan or over investment and too much sentiment and speculation that breaks itself, and the Fed has to hike rates and all that. So that second one, are we still like at risk of that? I mean, that's kind of the classic way markets turn lower when they're in bubbly periods, and one could easily argue that we still haven't had that situation. So do we need to be aware of that as a possibility, even as we're discussing economic recovery, that the market could get hit still?
Well, yeah, I mean, in a very short-term sense, I like to look at breadth or participation, just talking about the broad U.S. stock market. Mm-hmm. So we are seeing a high percentage of industry groups within the S&P 500 above their respective 50-day moving averages. So that breadth or participation is high. It's a contrarian indicator in the very short term. But the key question is here, as an investor, should you be selling the rallies or buying the dips? I think it's the latter, given this historical framework I'm serving up to you.